Okay, hello everyone. In this video, I'm going to talk you through a few strategies and tips to make the calculations in your cash flow budget for your project a little easier. Okay, so tip number one here is to really make use of the space outside of the budget for doing the analytical work and then just feeding that analytical work into the budget. And so, for example, in this budget, we wanted to identify what the inflows were going to be from wages. And so I made an assumption about what the wages would be per hour. And then I made assumptions for each month because the wages was going to stay, the wages per hour were going to stay the same, I'm assuming, through the year. We could change it if we wanted. But I'll make this assumption that the wages stay the same, but the number of hours would change. And so I can just calculate the number of hours in each month. And so you could imagine this for the number of attendees or the number of employees or something like that. And that could be just calculated here outside of the budget, but then you would feed that information in because this is just referenced with the number of the dollars per hour multiplied by the number of hours, and that will give us this total wage information for the year. Okay, so that's the first tip, is kind of make use of the space outside of the budget to do a lot of analytical work, and don't worry about maybe using kind of a row or a hard reference or something like that. Okay. The other, so here's another example of me doing that, which is the loan information here is outside of the budget on the bottom end. And this is so that I can feed that loan information up into here. And what you'll find is that I've roughly replicated some amortization schedule type calculations just per month on this horizontal view rather than in our amortization schedules, which usually went vertical. And so, for example, here I decide I need to borrow $1,000, and we'll revisit this because we clearly need to borrow more than 1,000 because we end up with a deficit at the end of the first month. So, but we'll talk about that in a little while. But we decide we're going to borrow 1,000. So I'm just referencing this. This actually references down here. Both of these cells, in effect, reference this $1,000 that's borrowed here. And so I feed that in because that's when it's borrowed. And up here, it's borrowed here. And then in the next time period, in February, we need to pay some interest. And so I pay the interest here in February based on calculating the interest earned by the previous month's outstanding balance. Multiplying that by the interest rate. But I use this kind of if statement, and you can look at it in your document. And what I do is I say if this value here in the previous month, and I round that value to no decimal places because I don't want to get into a situation where Excel thinks that there's like $0.00001 left to be paid, and just because there's a rounding issue, and then it retains, so then it triggers as false. I want it to be false if rounding to the pennies, the loan has been paid off. So I round to around this previous balance to the nearest dollar, and I say if the nearest dollar value is 0, then pay 0 because we're not going to pay any interest. Otherwise, pay this calculation of the interest payment, which is the outstanding balance in the previous time period times the APR divided by 12. And because I've built that if statement, I can just slide this whole thing over and autofill all the way across, And now if I make any change, then the to the interest rate or to the number of periods I want to pay this thing off in, all of that, that'll change my calculations automatically. All right. The second, and then that's the kind of similar kind of thing that's going on here with the cash borrowing, which is, again, looking down here to see if the previous balance is zero, and if it is, then we're not going to pay any principal back on the loan. But if it's not zero, if the condition is false, and there was a balance in the previous period, then let's pay the calculated payment minus how much went to interest. And so that's the principal payment. And then this value comes across. And so now you can see here, if you just focus on this line, you'll see that if I change this to 6 months, or if I change it to 3 months, it'll the whole thing automatically changes how quickly we will pay back the rate. So that's how we're going to deal, or that's one way of dealing with this cash or the borrowing and calculating how much you're going to pay in interest, which shows up in this cash disbursement this is kind of the operating cash disbursements. And then down here, this borrowing activity is focused on the principal information, not the outstanding liability, not the interest cost that are obtained or that have to be paid. But really think carefully often about whether an if function will help you to be able to create an analysis that's very flexible. I use if functions all the time to do that, and they can be really, really helpful. For instance, we could have another line in here that said if these hours were under 100, then the utilities gas costs would be $100. But if they were over 100, then the gas costs would be 120. And then we would just scroll over, and every time the if statement would look up to see what the work hours are, and it would populate the right amount of gas costs or fuel costs. So if statements can be really helpful, really powerful in helping you do your analysis. All right. I want to talk about two more things. One is, how could I calculate the break-even price in a function? You can think about it this way. What I want to know is how much do I have to be able to earn per hour in order to, by the end of the year, have this ending balance of zero, the ending cash balance be zero. So there are two ways to do it. You can see some of my work over here that's going to help us. One way of doing it is to use a goal seek function, right? We can do the what if goal seek, and I can say set this cell to 0 by changing this cell. And Excel will calculate $13.24. That's what we would need to charge in order to break even at the end. Now we still are going to have to deal with this issue that we have some months where we drop below 0, but this gives us a really good close estimate of what our break-even price is going to need to be. Let's go back to 15 here, and let's talk about how we could do this calculation without having to stop and do the goal seek function. And that's what's going on over here. You can see I have the exact same calculation, $13.24. And what I did was I took the total cost, which was the total disbursements. I just took that, and then that's the cost I need to cover. But that cost includes some things that don't need to be covered in that year with by the wages. Okay, so for example, that cost includes that we borrowed $15,000, or that we bought the car, but we bought it with a loan. We had to pay back some of it, but we haven't had to pay back all of it. And so the portion that we haven't had to pay back, we don't need the wages to cover. So I'm going to subtract out this long-term debt balance at the end of the year. Then I'm also going to subtract out this revenue that we get from other sources, because we don't need wages to cover the costs that those revenues will cover. I'll also subtract out the beginning balance of $600, because obviously if we already have $600 in there to apply to paying down those costs, we don't need the wages to earn those $600, and not in this year. And then that gives us this adjusted total cost of $18,223. And that's what the wages need to cover. So that's like the adjusted total cost that we want to calculate the average share of every hour of work performed, to figure out how much each hour of work needs to contribute to cover that adjusted total cost. So here's how much hours of work we perform over the year. This person does 1,376 hours of work. So we simply need to divide the total cost that needs to be covered by the hours of work by the number of hours of work, and that gives us this $13.24. And the beauty of this sort of approach is that we can now plug this information in, and it will automatically adjust. And now if we say, oh, wait a second, actually rent was $600 a month, we don't have to run another goal seek, because this is feeding in that information automatically to come up here and calculate the new break-even price that we would need to charge. Now let's go back to 500. Okay, last item to cover is how would I want you to deal with this borrowing, given that we're going to have to borrow money in order to, well, in your case, you have to borrow more than to have a balance in the bank account that's greater than zero. But in this person's case, let's just assume they need to be able to keep at least zero. There are ways of doing this that are more sophisticated. But for you, I would just say, just pick an amount at the beginning of the year that will make sure that you have enough in the bank all through the year. So we want this beginning balance to always be above zero through the whole year, and we want it here, so it'll show here. We'll focus on this line right here. Let me highlight it for us so that we can focus on it. And let's zoom in a little. So now we want to keep that so that it doesn't have any negative values. So let's just try 1,200. Well, if we borrow 1,200, we get a little closer, but we still don't make it quite. 1,300, still a few negative spots. 1,500, still some negative spots. We need to borrow something closer to, something closer to $2,000. Yeah. And then with $2,000, we have this 9. That's the lowest we get. And we hit 0 right at the end because we have those references. And every time we changed that amount, our break-even calculation over here is going to change what the price we would need to charge in order to cover those additional interest costs. Okay, so this would be the wage that our friend would need to have. Yeah, $13.25, because it's rounded up from just below that. If they get $13.25, then they will be able to break even at the year, but they will have to borrow $2,000 at the start of the year, though they plan on paying off that whole $2,000 by the end of the summer. That's when they make most of their money because they have more hours to work. All right, so those give you some strategies. You play around in the spreadsheet to understand what's going on in there, and then build out your own spreadsheet so that it will function in a way that will help you be able to do this analysis and be very flexible in being able to test other kinds of scenarios.